So, you're selling your business. It's the moment you've been working towards for years, maybe even decades. But once the dust settles and the celebrations are over, a really critical question comes up. How much of that hard-earned money do you actually get to keep? Well, here in Ireland, the answer to that really depends on how well you can navigate the tax maze. All right, let's get into it. Because if you don't have a plan, this is the number you're looking at. A capital gains tax rate of 33%. Think about that. That's a third of the value you've built from the ground up, just gone. It's a huge figure that can honestly turn a dream exit into a bit of a financial nightmare. And let's be totally clear, that's exactly what this is. It's not just a tax on a transaction. It's a tax on the late nights, the risks you took, the sacrifices you and your family made. This 33% problem is the one thing every single successful business owner in Ireland has got to solve before they even think about selling. Now, the good news is there are solutions. So in this explainer, we're going to give you a really clear roadmap. We'll start by digging into that 33% problem. Then we'll break down your two main relief options and how you choose between them. We're also going to shine a light on some critical traps to avoid, look at a pretty advanced strategy, and then we'll finish with what is probably the most important part of all, the long-term planning game. So, we've set the scene. That potential 33% tax bill is a massive hurdle. But thankfully, the Irish tax system does provide a couple of well-established pathways to get to a much, much better outcome. And these pathways are really two powerful tools in your toolkit. You've got entrepreneur relief and the more traditional retirement relief. Understanding how each one works and, more importantly, how they're different is really the first step to protecting the value you've created. And they are fundamentally different. Think of it like this. Entrepreneur relief is all about reducing your tax rate to something way more manageable. Retirement relief, on the other hand, offers the incredible potential to completely eliminate your tax bill. So it's kind of like a choice between a great outcome and a perfect one, but you guessed it, they each come with their own very distinct set of rules. Let's kick off with entrepreneur relief. This is the one that slashes that scary 33% capital gains tax rate all the way down to just 10%. That is a massive, massive reduction that completely changes the financial picture of your exit. But it's not unlimited. This 10% rate applies to gains up to a lifetime limit. As of right now, that limit is 1 million euros. But and this is a big but, it's scheduled to jump up to 1.5 million euros from the start of 2026. And that creates a really interesting strategic question, doesn't it? Could it actually be worth delaying a sale just to get access to that higher threshold? Okay, now for the other side of the coin, retirement relief. The potential here is just incredible. If you meet the right conditions, your tax bill on the sale of your business could be reduced all the way down to zero. Zilch. Absolutely nothing. But here is where the complexity really kicks in. That zero tax dream is subject to some very strict limits. If you're selling to an outside third party, it's capped at proceeds of 750,000 euros. And if you're passing the business down to your kids, brand new rules from 2025 are bringing in a $10 million cap. And believe me, there are some very complicated strings attached to that. So, how do you actually qualify for these amazing reliefs? Well, this is where you have to understand the rules of the road, because these two paths have very, very different entry requirements. And this table just lays out the difference in philosophy perfectly. Look at entrepreneur relief. No minimum age, you only need to own the shares for 3 years, and you only need to spend about half your working time there. It's flexible, it's modern, it's designed for today's founder. Retirement relief, on the other hand, is much more traditional. You have to be at least 55, you need a 10-year ownership history, and you have to have worked, and I quote, substantially the whole of your time in the business. And this is crucial. For shares, you must have been a director, whereas even an employee can qualify for ER. For entrepreneur relief, it's actually pretty easy to remember. It just boils down to this little phrase, the 5-3-3 rule. You've got to own at least 5% of the shares. You have to have owned them for a continuous 3-year period, and you have to have met that working requirement for 3 years. It's a nice, clear, straightforward test. But just knowing the rules isn't enough, not by a long shot. Both of these reliefs are absolutely littered with pitfalls that can catch out even the most careful business owner. And this is where a simple mistake can literally cost you hundreds of thousands of euro. Let's start with what is probably the biggest trap for entrepreneurial relief. If you start your business as a sole trader and then later you incorporate it into a limited company, all those years you spent building the business as a sole trader, they don't count. The 3-year clock for both share ownership and your working time. It starts all over again from day one of the new company. It's brutal. Let's see how this plays out in real life. Take the example of Mary. She ran a successful pharmacy for 20 years as a sole trader. In 2023, she incorporates. If she then sells in 2025, she has only owned the shares for 2 years, so she fails the test. The cost of that mistake? Well, on a $2 million sale, it would cost her an extra $345,000 in tax, compared to if she had just waited 1 more year. Ouch. Now, for retirement relief, the biggest danger has a specific name: clawback. What this means is, you can get the tax relief on day 1, but if certain conditions aren't met down the line, revenue can actually come back and demand that the tax is paid after all. And this has become a huge risk under the new rules. You see, for large family business transfers over 10 million euros after 2025, the parent can defer their tax. But here's the catch. The child is now locked in for a whopping 12 years. If they sell that business anytime in that period, that clawback is triggered. And here's the real kicker. It's now the child who has to pay the parent's original tax bill. That is a massive commitment and a huge risk to put on the next generation. Okay, so we've seen the rules and we've seen the traps. Now let's look at how this all comes together in an advanced strategy. Because you know what? Sometimes the most obvious choice isn't actually the best one, and you really, really need to run the numbers to see which path is better for you. So let's use a practical example. Imagine you're selling your business for 1.75 million euros. You qualify for retirement relief, but the sale price is well over that 750,000 euro limit. You also happen to qualify for entrepreneur relief. So which path is going to save you the most money? This bar chart tells the story perfectly. At the standard 33% rate, your tax bill is eye-watering, over €500,000. Now, even with retirement relief, because you're over the limit, a special marginal calculation still leaves you with a $500,000 bill. But look at entrepreneur relief. By paying 10% on the first million and 33% on the rest, your total tax is just under $350,000. This is the key takeaway. For those bigger exits, that 10% rate from ER can be way more valuable than the zero-rated but very strictly capped retirement relief. And all of this brings us to the single most important conclusion of this entire explainer. Tax efficiency on your business exit is not something you figure out in the year you decide to sell. It is a long-term planning game. Because all of these reliefs depend on clocks that started ticking years ago. You need a 3-year runway for entrepreneur relief. You need a decade of commitment for retirement relief. And if you're planning a big family succession, you're imposing a 12-year clock on the next generation. These timelines mean that the decisions you make today will directly determine your tax bill in 5 or even 10 years' time. So we'll end with this question. It's not just about whether you're ready to sell, it's about whether your business, your company structure, and your personal circumstances are all aligned with these long timelines. So the question is your business ready for the clock?